really, the mobile phone revolution was the first of these mega network effect businesses. So what is a network effect? Well, a network effect is if there's one mobile phone in the world, it's worth nothing. If there's two, it's worth something if you want to speak to that person. If everybody in the world is connected, it's one of the most valuable things you could possibly have. And then if you look at what happens with networks, once they become valuable because you've connected people, you can build other things on top of them. So the value of the network grows exponentially. And this was coined into something called Metcalfe's law. And Metcalfe's law suggests that you value a network based on not only the number of nodes, people on the network, but the number of connections they have with each other. Because the number of possibilities, much like we talk about the call option in Bitcoin, it's basically the same thing. What it's saying is the more people are connected, the more likely it is to create value. So what happened is this started with the internet on a dramatic scale, of a scale that humans couldn't imagine. And suddenly all these businesses became crazy valued. We didn't really understand how to value stuff. Why did Amazon trade all the way from like 99 to 2012 at a P of 800? Because it was not a normal stock, it was a network effect stock, because it created a gigantic network. And that whole network effect leads to something called exponentiality. So there's a number of things in a network as well. You talk about the Lindy effects and S-curves, is basically a network that comes under attack and survives is generally proven to be more robust, which is the Lindy effect, and the higher probability it has of thriving because it's proven its robustness. And networks are distributed in nature generally, so they tend to be quite robust. Then you have something called S-curves. So then that's the moment in time where these big questions get asked. Like in Bitcoin, it was when the forking happened or when Mt. Gox went under. Is this network going to survive or not? Or we've kind of run out of use case for the time being of the network. And we've kind of seen that with Facebook recently. It's kind of like, it's kind of run out of where it's going with Facebook, WhatsApp, and Instagram. Although you and I know that it's actually going somewhere different. And it's starting to be reflected in the shares. But those things all come together. And as the adoption grows, the prices go exponential, which means that to anybody else, it looks like a bubble. And nobody understands it. It's like, this is crazy. And you can see this all over social media. But when you put it into a log chart, it's actually a very smooth progression. And that is how you have to look at these exponential assets. They're not like anything else. What's so good about them is they offer this upside that is beyond comprehension. This is why Bitcoin's gone up 2 million%. Nothing else has ever done that before. So we have a very skewed risk reward. Now, Bitcoin could go to zero every year, let's say. But on average, it goes up 213%. I mean, that's an extraordinary risk reward every single year. And that's the power of exponentiality. These exponential assets also tend to be very volatile. Look at the tech stocks. They've always been volatile because it's all about network adoption. Everything else is kind of noise in the middle. Once you understand network adoption is everything, and we talked about it earlier on, about this 113% growth rate, you kind of understand, and you can apply that to everything in the crypto space and in the metaverse space. You're just looking for adoption. Anybody who's trying to value stuff on cash flows or anything else is barking up the wrong tree. It's how many people are joining the network, are they using the network, and how many other applications are being built on that network. And that's what makes, whether it's Ethereum, which is a phenomenal network effect, or Minecraft, these are so valuable because everything that's being built on these networks.
Yeah, and obviously with the former, I know you've highlighted the thing that's different here is that everybody, in theory, can now access that exponentiality as a shareholder in a way, right? So
that's a really crucial point. So in the past, Facebook had shareholders and users. The users got the benefit of the network. The shareholders got the benefit of Metcalfe's law, the value of the network. And as a user, you didn't get that at all, really. Then Bitcoin comes along, and it's basically the world's best behavioral incentive program. It's like the best thing behavioral economics could have ever devised as a human experiment. We're going to create a network of money. And the more people you bring into the network, the more it goes up in value. And we're going to build applications on it. So it's not a Ponzi scheme. It's actually something you can build on. This is like perfect for humans, that we're going to go crazy on this stuff because we're all incentivized. Now we're all network users and owners at the same time. It's like every single person on Facebook being given Facebook shares. It's amazing.
Yeah, and to be honest with you, I'm always blown away by economists that aren't excited by this. And not just Bitcoin, but...
They don't get it because they're mean reversionists. Because our careers, even as macro guys, is it's a bubble, let's short it, we'll make money. The business cycle's overheated, it's going to come down, bonds are oversold, they're going to... All of these things are mean reversion. And that's the linear world. Mean reversion in an exponential trend is basically back to the exponential moving average, which is always rising. And that logarithmic trend.